Okay, folks, so this is a continuation of the call credit spread live video tutorial that we did a couple of days ago. So that ended up being an hour long and I still wasn't able to enter the trade. And so we're just going to do a little continuation video to see if I can show you how to close, how to exit a call credit spread. So this is unfortunate. It looks like my machine is locked up. Give it a little bit, see if it catches up. Okay, here we go. Okay, so this Zoom spread is the one that I tried to get into in the previous video and I was not successful, and so the video was getting kind of long, and so I just didn't want to just extend it and just wait until all my entry criteria had been met before I entered the trade. But you can see now I'm obviously in the trade, so I opened a call credit spread 410, where I sold the 410 strike that expires today, and I bought the insurance, sold the 430 strike. So Zoom is dipping hard this morning. I am up 92% roughly on the trade, and so there's just not a whole lot. Now it's up to 96%, so I'm ready to close this trade out. So in order to close the trade out, so you just do the opposite of what you did to enter the trade. And so I sold to open, and so I would just buy to close. And so in buying back the trade, it's going to cost me this much right here. So $50 to close this trade. I'll still lock in 95% profit. So let's see if I'm able to do that. So I just right click here. I'm just going to close this trade, click place order, and we'll see if it executes. So we can look at the pending orders. Looks like I'm not able to close it at the moment. Let's just look at this. So I have a 20-point wide spread. So again, 410, 430, which is this one that we were looking at the other day. So we want to switch over to the calls. So you can see that most of the value here is pretty much gone, right? And that's what we want as a seller. So we want the value to decay to a point where it's costing us very little to exit the trade. Or if you're feeling pretty confident, you can just let this expire, and then if it does expire out of the money, you will collect the entire premium. You'll capture the entire premium that you collected to open the trade. So you can just look at the 5-minute chart. So you can see Zoom selling off this morning, which is good. My strike is 410. So up in, above this range, it's moving away from my strike, and as a seller, that's what you want. That means that your unrealized profit and loss is increasing. The value of these contracts are decreasing, and so you can close out this trade for profit, assuming you can actually close it. I'll try and close this again. So I have 5 contracts. If I close it at this mid price of 15, and it keeps bouncing around, obviously this is dynamic, the stock price is moving, and so these premiums move along with it. And so let's just try and sell this at $15 per contract times 5 contracts, $75 to close this if I get a buyer. seller. So in the previous video tutorial, we talked about liquidity. And so since I'm trying to buy to close this contract, typically the default is this midpoint price. So the difference, so the midpoint between the best bid and the best ask is 15 cents. So halfway between 10 and 20 is 15 cents. And so that's what this number is. And usually the software will default to the midpoint. And even though there's quite a few open interests, so quite a few contracts that are open, I don't really know if those are call contracts, put contracts. All you know if that is that there's 2,691 contracts that have been open and need to be closed at this spread, 410, 430. Okay, so as the ask is coming down to what the mid price was, then I stand a better chance of getting filled, because now what I'm offering to buy these contracts back is around what the midpoint or what the ask is, or at least it was. So I still didn't get filled, but if the stock price dips a little more and the ask is reduced a little bit, then I have a better chance of getting filled, because that basically means I'm offering to pay what the sellers are willing to sell those contracts at. But if I really wanted to get out of this trade, since it's really only the difference between $75 or $100 to get out of this trade, then I just increase my bid price to what the ask is. So let's try that. So we'll cancel this. Look at my position. So we're just going to increase that. So if I go and try and close this, so instead of offering $15 per contract, I bump it up to $20 per contract. So it's going to cost me a total of $100. Let's see if I can get filled at that price. Sometimes you just have to wait and see what the price action does. So as I'm setting my order, if the stock price starts to rise, then the premiums rise with it, and so go the ask, so they increase a little bit. If the stock price dips while I have my order set at 20 cents and this comes down to 20 cents, then chances are I'll get filled. So we just have to be patient. I don't necessarily want to keep chasing this ask upward and paying more to exit the trade, even though we're only talking a few bucks. So I'll just see if the stock price reverses a little bit, and if these asks decrease a little bit, and if so, we'll see if I get filled. And so these are increasing quite a bit, the ask, and that's because the stock price is actually rebounding. You can see it dipped as low as 389. Now it's moved up to 393. And so, like I mentioned earlier, the premiums increase with the stock price increase. The premiums decrease when the stock price decreases for call options. And so just be mindful of liquidity. We talked about in the other video. If the spread is kind of large, so it's bouncing between 20 cents, 15 cents or so, sometimes that makes it difficult to exit the trade. So you might have to go above and beyond what you would typically offer to exit contracts with very little value. And this is really just trying to protect the profits you've already realized. And so if I'm up, I was up close to 95%, now it's dipped a little. If you want to protect that, then you may have to offer a little bit more to exit the trade. So I'm still offering 20 cents per contract. See if the stock price decreases a little bit, it is starting to reverse. So if it dips past this 392 level, then we may see those asks move towards my offer of 20 cents. See if I can exit the trade then. So you see it now, the ask is 20, I'm offering 20. And sometimes you just have to wait, and there you go. So my offer was taken at 20 cents, my order got filled. You saw my pending order disappear, which means that I am no longer in that trade. And you also see that credit spread is no longer a part of my positions. So now I'm totally out of that. So that was a 3-day trade, or 2-day trade actually, where I tried to enter the spread while I was doing a live video. I wasn't able to, the video was getting long, so I stopped the video. I kept trading though, so I didn't stop trading, I just didn't want the video to be 2 hours long. I eventually was able to enter the trade, and I collected $900 roughly in premium for those 5 contracts, and I essentially locked in a little over $800 on that trade. So that's not bad for 2 days. Now you notice I'm actually in another Zoom trade called credit spread that expires next Friday, and you can see that currently sitting at $300 in profit. So again, if I wanted to, I could exit this trade now. I've made 12%, but there's still quite a bit of value, market value, that's still left on those contracts. That is mostly extrinsic value. We can probably talk about that in another video, but since these contracts are out of the money, there's no intrinsic value with these contracts, so it's all time value and volatility, which is extrinsic value. And so since we've got 5 days left on the contract, 5 working business days, that is extrinsic value, and that's mostly what this market value of $1,800 is made of. So as time moves forward and we're still out of the money, then the more that my P&L will grow, the cheaper these contracts will get, and I can exit these contracts for much less than the credit that I received when I opened them. So as a seller, you want to time your entry, and then once you enter the trade, ideally you want to see this price action. So you want to see it sell off for a call credit spread. For a put credit spread, you want to get in at the bottom, and after you enter, you want to see the price action increase. and then you'll start seeing green P&L. So I'm going to go ahead and end this. This was just a follow-on to the previous video tutorial that we did. So that was a pretty good trade. Really minimal risk. It never came close to my strike price. It moved away as we had anticipated, and so I was able to realize roughly 90% profit on the trade. My target is between 50% and 75% profit, and so if I see that on the trade, I usually start looking at exiting. But if the stock price is nowhere near my strike price, then I may let it run a little longer, capture more of that premium before I exit. So that's kind of what I did today. It got as high as 90%, but I'll still hold this one and determine when I want to exit that trade. But it probably won't be today, since we still have quite a bit of time, 5 days left on the trade, and I'm hoping Zoom stays in this range, well below 400, and I can start realizing more of this value that's currently left on those contracts. So hopefully that helps. I will get this published today as a follow-on to the previous video, and so you're able to see both me entering a trade, me watching the price action, and exiting the trade, and able to lock in that profit. So any questions, feel free to drop them on the YouTube channel or in the Facebook group. Be sure to get those answered. All right, have a good one. Thanks.